Over the last 12 months, central banks around the world have reportedly increased their gold reserves significantly. At the same time, many large institutional investors have been adjusting their portfolios to include more hard assets like gold. Gold prices have risen strongly in recent years, and some financial analysts believe interest in gold is connected to concerns about inflation, government debt levels, and global economic uncertainty. At the World Economic Forum in Davos 2026, hedge fund manager Ray Dalio discussed long-term economic cycles and how global financial systems tend to change over time. Dalio has studied economic history for decades, and his research focuses on how debt cycles and currency systems evolve. He explained that throughout history, monetary systems have changed multiple times, often influenced by rising debt levels, political tensions, and economic restructuring. However, it's important to understand that economic outcomes are never guaranteed, and markets can behave in unexpected ways. Most people are familiar with trade conflicts between countries, but some economists also discuss something known as capital competition. This refers to situations where countries adjust where they hold their financial reserves based on geopolitical risk, sanctions, or currency concerns. Governments sometimes diversify reserves across different asset types, including currencies, bonds, and precious metals. Gold has historically been one of those reserve assets because it is globally recognized and not tied to a single country's monetary policy. Several central banks, including those in emerging and developed economies, hold gold as part of their financial reserves. Some investors include gold as part of a diversified portfolio. Dalio has publicly suggested that diversified portfolios sometimes include a small allocation to gold as a risk management tool rather than a profit-seeking asset. Historically, financial planners sometimes discuss allocations ranging between 5% and 15%, depending on risk tolerance, financial goals, and market outlook. But these percentages are general discussions, not personal financial advice. Every individual situation is different and should ideally be reviewed with a licensed financial professional. While gold can sometimes help during economic uncertainty, it also has risks. Gold produces no income or dividends. Prices can remain flat for long periods. Storage and insurance costs may apply. Market timing remains unpredictable. That's why most professional investors focus on diversification instead of concentrating heavily in any single asset. Investors interested in gold typically consider multiple options: physical bullion, coins or bars, gold ETFs, mining company stocks, gold-backed digital assets. Each option carries different risks, storage considerations, liquidity levels, and cost structures. Physical gold requires secure storage and insurance. ETFs and mining stocks carry market risks and management fees. There is no universally best option. It depends on personal goals and circumstances. Throughout financial history, the investors who tended to perform better long-term were those who focused on diversification, risk management, long-term planning, avoiding emotional investment decisions. Gold is often discussed as one potential tool within that broader strategy, not a guaranteed solution. Global markets are constantly evolving. Governments, institutions, and individual investors all adapt differently depending on economic conditions, risk tolerance, and long-term objectives. Understanding history, studying macroeconomic trends, and building diversified portfolios are generally considered more sustainable approaches than reacting to short-term headlines or predictions. If you're interested in gold or any other investment, always research carefully and consider speaking with qualified financial professionals before making decisions.